today we are going to be talking about Regulation A versus Regulation D for apartment syndication, and which one of those two is the most popular and why. Are you allowed to advertise your deal? What are the limits that you can raise on each one? And should you hire an attorney? And of course, as usual, a bunch of other things that I like to throw in there to make these webinars very, very interesting. So to get you started, as an introduction, I'm Dan Handford. I'm actually one of the managing partners of a group here called PassiveInvesting.com. And you can go to PassiveInvesting.com if you'd like, and you can click on Meet the Team to be able to go to our page here and see our two managing partners, myself and Danny Randazzo, and then the rest of our investor management team. You can also see our marketing and events team, our acquisitions and asset management team, and all the other different business lines that we have with self-storage. We also have our finance and our HR team. We also have our rehab wallet and our debt fund team. And then, of course, we have our car wash and operations team there as well. So you can see our entire team there. If you want to find more information about me, instead of taking the time each webinar, you can go to this team page and click on my picture. There is a video there that I did that talks a little bit about myself, and then also some additional content here with me as well. I do live and work here in Columbia, South Carolina, with my wife and our three girls and a boy. So I have 3 girls and a boy. The oldest is 12. She's our girl. Our second child is our boy. He is actually turning 11 next month. And then we also have a 6-year-old girl and a 5-year-old girl. And we have a standard dog, a standard poodle named Bella. So that's a little bit about myself and my background. You can find out more information about that here. We have grown this company from 0 assets under management to acquiring just over 1.4 billion in assets since 2018, and we currently have about 1.4 billion in assets under management and have raised just over $600 million from our private accredited investors. So we have not accepted any institutional money up to this point on the equity side. Obviously, we work with institutions when it comes to the debt and the lending portion of things. That's typically the side of the transaction that the institutions primarily live on. But we only have accepted funds from private retail investors. So we're going to be talking about the different types of offerings that you can do as an operator, but you can also see some of our offerings here. We have our Car Wash 5 offering that is still open, has about $1 million left in that one. Our Storage 2 fund, and then of course our debt fund there as well. We have some funds that are still available there. Our primary holdings is actually in multifamily. So we have about 1.1 billion in assets under management in just multifamily, and the rest is a kind of smattering of about 300 to 400 billion in between car wash, hotels, and self-storage. And so we do have some opportunities that are still available that you can look at if you'd like. If you'd like to join us in some of our future acquisitions, you can go to this top right-hand corner, click on Join the Passive Investor Club. When you click on that, there will be a form that gets presented to you. If you fill out this form, one of our investor relations team members will reach out to you, discuss your investment goals, and see if we are both a good and right fit for each other before we move forward with each other. So feel free to do that. Love to be able to have that conversation with you. And for those of you who haven't heard about it yet, to go to mfincon.com and with mfincon.com, you can register for our next event coming up called the Multifamily Investor Nation Convention. We're going to have Dr. Robert Cialdini, author of Influence, The Art of Persuasion, one of my all-time favorite business books. That's actually not a business book, but on human social psychology. Would highly recommend that you get that. We also have Mark King, the CEO of Taco Bell, the current CEO of Taco Bell. He'll be there speaking on leadership principles. And of course, Joe Fairless, who's one of the founders of Ashcroft Capital, as well as the Best Ever podcast. So he's going to be there with us as well. I'm not going to go into too much detail here, but would love to have you at this event. It's a Monday, Tuesday, Wednesday, so you're not having to worry about taking over any of your weekends or anything like that. You can spend some time with us, my entire team, here at this event in Charlotte, North Carolina, coming up in June 12th, 13th, and 14th. So let's dive into the material today. Today, we're talking about Regulation A versus Regulation D. So which one of these is the most popular, right? So the most popular between Regulation A and Regulation D is Regulation D. Now, let me actually get my screen sharing device up here for you so you can kind of see some of this stuff that I want to present to you. Oh, there it is. All right, I'm gonna get my little notepad out here to make sure I have a good connection. So I want to share with you these two different types of offerings that are available here. So I'm going to go to these quick sheets here, go to this next page, new. Okay. And I'm going to template layer this as, I'll just leave it like that. Going to present with screen share, connect the app, accept here. And I'm going to share with you on my screen, I use a device called a remarkable device. So if you guys have never heard of that before, it's a little device on my camera. If you can see me here, looks kind of like this. It's like this. And as I write and I type on this thing, you can see it on your screen, which is pretty cool. It's completely wireless, which is pretty cool too. I love technology, love little toys here and there. We're going to chat about this just a little bit. But what I wanted to share with you is the kind of the differences between the Regulation A and the Regulation D. So I think it will help you kind of understand what this is here. Okay, all right. Trying to bring up a spreadsheet that I normally have up here, but that's okay. So there, I want you to kind of follow along here. We have a couple of different things that are going on here. So I'm actually going to put Regulation D here on the left, and then you have Regulation A on the right-hand side here. And so what you also, in between each one of these things, you have what's called 506 Bravo, and you have a 506 Charlie, okay, under Regulation D. And under Regulation A, you have a Tier 1 offering, and then you have a, let me make a correction there. And then you have a Tier 2 offering, okay? We're not going to get into too much detail with this kind of Tier 1 option here, and that actually is supposed to be an R there, so Tier 1. But the questions, a couple of the questions that I always come in about this one is that which one's the most popular, right? Which is the one that most people go after? When people are first getting started in the syndication space, the one that they use the most is going to be this one right here, which is the 506 Bravo. 506 Bravo is the most popular because it's the easiest one to get started with. You don't have to worry about verifying accredited investor status from a third party. It's something, actually, let's see here. They're saying I can't see. One second here. How about that? Now can you see? Thank you guys for sharing that information with me. I forgot to share the proper window, so I apologize for that. All right, good. Now you can see it. All right, cool. Sorry about that. So now you can see on my screen this beautiful drawing that I've made, and I'm not the best artist, but now you can at least see and follow along with me as I'm going through the material here. So a couple of things that you can see here in regards to kind of the 506 Bravo versus 506 Charlie is that the 506 Bravo is the most popular, and it's because this is where you could bring in family and friends, right? And they don't necessarily have to be accredited, but one of the things you do have to have is you have to have a prior existing relationship with them in order to bring them onto one of your deals, right? This is the one where if we can say advertising, is it allowed? Question mark. And the 506 Bravo, no, you are not allowed to advertise the deal, right? On a 506 Charlie, you can. You're allowed to advertise the deal. Now, when it comes to the accredited investors, like we were talking about earlier, you are allowed to have accredited investors, as many of them as you want. But as far as non-accredited investors, you can have up to 35. Okay, and these have to be what are called non-accredited but sophisticated investors. That means that even though they're non-accredited, they still have to be sophisticated enough to be able to understand the risks and the merits of the investment that they're getting into and be willing to lose it all. Not be willing to, but understand that they could potentially lose it all, right? So that would be considered a non-accredited yet sophisticated investor, right? You can have up to 35 in a 506 Bravo. Now, the accredited investors, you can have, yes, you can have as many of them as you want. You can also, in a 506 Charlie, have as many of them as you want. But when it comes to non-accredited investors, no, you are not allowed to have any accredited, non-accredited, sophisticated investors in your investment offerings. Now, there's really two ways to be an accredited investor. One's by income, one's by net worth. There are some other different nuances and different ways to become an accredited investor, but those are not the norm. There are some additional ways by being registered to sell certain securities and things like that. I've looked into them. It's more trouble than it's really worth if you're a non-accredited investor to have to go through all that process, that hassle. So we don't typically recommend it, but there are some other options available for those that want to do that and become an accredited investor for particular offerings. But for all intents and purposes, 99.9% of your investors will either meet the income, which means you have to have, if you're single, 200,000, or if you're married, 300,000 of annual income. You have to have had that for the last 2 years and have a reasonable expectation for it to continue into the future. The other reason, the other way to do it is by net worth. So it's either or. It's not one, it's not both. It's either or. So if you meet the income requirement, great. You do not have to meet the net worth requirement. But if you don't meet the income requirement, then you can meet the net worth requirement. So the net worth requirement is that you have at least $1 million of net worth. That does not include your primary residence. And so that could be business value and business assets. It could be real estate holdings. It could be the stock market. It could be a 401k, an IRA, retirement accounts. You know, whatever that amount is there, you can use to be able to add to your net worth to be able to become an accredited investor. Okay. Now, in a 506 Bravo, they are, how do they verify that they're an accredited investor? Right? How do they verify this? This is actually self-accredited on a 506 Bravo, which is basically saying that they're going to sign a document stating that they're an accredited investor. You don't have to do any third-party verification or anything like that. Now, on the 506 Charlie, it's not required to do third party, but to take that liability off of yourself and your team and having to worry about looking at all these different documents that could come in from a potential investor, usually a third party is used. We use one called Parallel Markets. We also used to use one called Verify Investor. We prefer Parallel Markets over Verify Investor just because of the way they kind of like charge and handle their billing, if you will. But we use one called Parallel Markets, and you basically send a link over to the investor, and they fill out the forms, and within about 3 to 4 hours during the week, you usually get a response back pretty quickly. They say up to about 24 to 48 hours, but they're usually pretty quick about it and responding and signing off that investor is an accredited investor. And so those are the primary things when it comes to this. And the other question is okay, well, let's talk about Regulation A here, right? So can you advertise a Regulation A offering, Tier 1 or Tier 2? The answer to the question is oops, it just jumped on me here. Let me fix this here. The answer to this question is yes. Okay. So yes, they can. They can do that, right? Let me just move this up and down here just a moment here. Reset this thing. And so you can advertise those. Now, you can accept accredited investors on both of these as well. Okay. You can also accept an unlimited amount of non-accredited investors, and the verification is third party as well. Okay. Now, just so you guys know, full disclaimer, I am not an SEC attorney. So one of the last questions I have on this for the topic for today is, should you hire an attorney? And the answer to that question is yes, absolutely. So this is information that I have found from my own research, from my own education, and talking with our SEC attorneys and things like that. We also have in-house counsel that works for us, so we have resources at our disposal to be able to verify some of this information. But I'm not an attorney, so I could be misspeaking about some of this stuff. So make sure that you do your own due diligence when it comes to these types of things that could be legal issues for you down the road. Now, the next question here is what are the limits that you can raise for each one of these different offerings? Okay. So let me just double check one thing here. All right, I just wanted to double check one thing. So a tier 1, so we're going to put this as the limit here. The tier 1 is a $20 million limit, and the tier 2 is, I believe, a $75 million limit. Yes. So the tier 2 is a $75 million limit. So this means that if you do a regulation A, tier 1 or tier 2, tier 1 is a $20 million limit, which is the most you can raise in a 12-month period. And then the tier 2 is $75 million. Now you can have multiple ones of these going on at the same time, but you can only raise a certain amount every year with each one of these different types of offerings. Now, what's the limit on a 506 Bravo and a 506 Charlie? Exactly. There's not one. There is no limit as to how much you can raise from these different investors. None. Okay. You can do $100 million funds. You can do $1 billion fund. You can do $10 million fund, however you wish to do it, right? Most of your limitations are going to be on how many investors you actually have, depending on if it's a 506 Bravo or a 506 Charlie. Now, then your question is why would I choose to do a regulation D over a regulation A? Regulation A makes it look like I can do more. I can advertise the deal. I can advertise. I can bring in my accredited investors. I can do non-accredited investors. What's really the benefit here? Okay. Let me bring this over here just a moment. Somehow this got disconnected. Let's present again. There we go. So hopefully now you can see this screen. There we go. Sorry about that. Yes, it did get disconnected there. So what's the main reason? Like, why would you? Like, it looks to me from on the surface that regulation A is a much more appealing offering than a regulation D offering over here. So why not we just we'll do regulation A's? Here's the problem: time. Time is the biggest component here. With a 506 Charlie and a 506 Bravo, a couple of days maybe. I mean, I could call the attorney up today and have an offering release this afternoon on a 506 Bravo or a 506 Charlie. That's how fast you could put one of these things out, right? It's all a limitation on how fast you can get it going. The tier 1 and tier 2, that's a different story. These usually take between about 4 to 6 months to get started. And the reason why is because the SEC actually does a pre-approval. Okay, so there's no pre-approval for these, but there is a pre-approval for both of these. Okay, and that's why it usually takes 4 to 6 months. So if you're buying an asset, you can't really, you can, but no seller is going to want to sell to you if you tell them, oh, by the way, I need about 6 months to get my offering put together, right? They're going to say no to that every time, right? Nobody wants to wait 6 months for you to be able to put something together in order to acquire their asset. And so the 506 Bravo is the number one that is done because it's the easiest. There's no verification with investors or anything like that. As you continue to grow and build your group, you're going to likely migrate over, and you're going to primarily be into this 506 Charlie phase. And that's where we live. So at passiveinvesting.com, the primary thing that we're acquiring is assets through the 506 Charlie type offerings. Okay. We are looking at and will likely over the next 4 to 6 months have a regulation A fund set up, and it'll be a tier 2 regulation A. Because there are a couple other nuances to the regulation tier 1. It also has a lower limit. So, but the reason why the tier 2, the reason why you're able to bring on additional investors, unlimited amounts of non-accredited investors, is because you now have to get pre-approval. And so the SEC is going to do background checks on all the operators. They're going to do checks to make sure there's no money laundering going on. They're going to do a lot of different due diligence items, if you will, and checking some additional boxes to help the non-accredited investor do their own due diligence for them, right? And if you look about it, if you think about the SEC, they were designed for really only one reason: it's to protect the little guy. Because once you become an accredited investor, as you can see, they don't really care about you. Whether you're a 506 Bravo, Charlie, Tier 1, Tier 2, if you're an accredited investor, yes, come all day long, you can invest in whatever you want. Now, one of the limitations that they do put on the non-accredited investors, specifically for Tier 2 Regulation A, is that the non-accredited investor has a limitation in the amount that they're able to invest. They're not allowed to invest any more than 10% of their income or 10% of their net worth in any given offering in a given 12-month period. Now, they could have 5 different offerings that they put that 10% into, but they can't in one offering put any more than 10% of their net worth or 10% of their income, in whichever one is greater, into an offering. So there are some limitations. Most of these kind of like Regulation A offerings are opened up with a lower minimum, usually between about $5,000 to $10,000 minimums to be able to invest in those, but it still allows the little guy to be able to invest alongside you in some of your offerings. And what we're putting together is a diversification fund, which allows our investors that maybe don't have the high net worth to be able to still invest 5, 10, 15, 20,000 alongside us, and we'll diversify those funds across 5, 10, 15, 20 different assets as we continue to acquire assets, and so that we can basically be using that Regulation A fund alongside our acquisitions for some of our future properties. So anyway, so I know this was kind of like a Regulation A and D kind of 101 class. I didn't get into a lot of details here on each one of these things. I know that this seems like there's quite a bit of details here. There's more details than this. And if you go to our YouTube channel for Multifamily Investor Nation, you just type in securities or SEC or Regulation D or whatever, 506 Bravo or Charlie, you'll find some additional webinars that we've done that dives a lot deeper inside of these different tiers. I do want to open it up for a few minutes here. I have about 3 minutes left here to be able to answer some questions for you. So I will open it up to the floor. I know there's a couple of questions already in here, so let me answer a few of these. So Louis is asking, Regulation A is most likely for funds, right? Instead of raising funds for a specific deal. You are correct. The Regulation A is typically where you're going to buy multiple assets in one fund, but you could also open up a fund, which is Regulation A, and just buy one asset in there if you wanted to. The problem is the cost. That's one thing we didn't cover is the cost to be able to get these things set up. And so if we go back to this chart, the 506 Bravo and Charlie is going to cost anywhere between about, I'd probably say 10 to 15,000 for the legal fees. You're going to also have your Blue Sky filing fees, and those, depending on the number of states, is going to be $5,000 to sometimes up to $20,000 for each one of these things. So it really, this number down here really just depends on the number of states that are involved, right? Number of states, because each state that you accept investment money from an investor on, you have to file in that state, letting them know that you accepted some funds from there and how much it was, and so they can. And then some states charge you, $1,500, $2,000 to register in that state. If you only have one investor, you have to register in that state. These same Blue Sky filings would apply as well across the board here in Tier 1 and Tier 2. The cost, though, goes exponentially, not exponentially, it goes significantly higher. So typically on the low end, these are going to be $75,000 upwards to, say, $125,000 for both of these types of offerings, depending on how many comments are coming back and forth, right? And I know I lost my screen share here. Let me see if I can get this back up. My screen share is the screen again here. All right, so I'm back with you now here on this screen sharing thing. Going back to my chart here. So as you can see, that's another factor when it comes to just raising it for just one offering would be a little bit expensive there. All right, let's see here. So most of the time you are correct. It is done for funds where they're buying multiple assets in one deal. Can a SPAC use Regulation A as a funding source? I'm not 100% sure on that, Ron. It's a good question. I have not done a lot of research on the use of a Regulation A with a SPAC, but definitely an interesting question for sure. What is your average rate of return? So it depends on the asset class. So on the lower end assets, our Our returns are, projected to be between 12 to 13, maybe 14% on some of our kind of Class A multifamily assets. And then on the other side of the spectrum, we have our kind of express car wash fund that we have, which gets usually between about 20 to 25% rate of return, depending on which offering that's put together and the types of assets that we're buying. But we acquire multifamily, self-storage, hotels, and express car washes, and then we also have our debt fund. So if you would have a blended return of the full cycle exits that we've done, we're north of 28% annualized return for the assets that we've been able to go full cycle on. All right, last question that's come in here is, doesn't the Regulation A have an educational component to it as well? Educational component for what? I don't really know. Maybe has something to do with the investors have an educational component to it, and the answer is no. So there's no requirements for the investors. There's no educational component that I'm aware of when it comes to Regulation A. So Regulation A, it's very clear: Tier 1, Tier 2, unlimited amount of investors as long as they meet the certain requirements for income and net worth, and not investing more than 10%. But there are no other limitations to that. Now, there's definitely some reporting requirements that are involved with a Regulation A, Tier 1 and Tier 2, but there are no ongoing like educational requirements or anything like that. All right. Well, thank you for bearing with me today with the technological glitches. Appreciate you staying tuned with me. For those of you who have not done it just yet, I know several of you have already gone to the website, and I've put your information in to be able to register for the MFIN Con coming up. That's coming up June 12th, 13th, and 14th. So make sure you go there and be able to rub shoulders with a lot of different people. There's going to be over 50 speakers that are going to be there. I'm going to be there. You'll just shake hands with me, and then also a lot of these other speakers there. Other managing partner, Danny Randazzo, he's going to be there. I've got Rod Cleef on there, Darren Batchelder, Rob Beardsley, Chris Larson, Kelly Garrett, Sandia Sahidra is going to be there. Sashidra is going to be there. Holly Williams, our director of marketing and PR, Melissa Broom is going to be there. Kevin Bupp, Travis Watts there, investor education director for Ashcroft Capital. Chris Bennett, Vanessa Peters, great lady there. Enjoy spending time with her and hearing her sessions. Our transactional real estate attorney, Norm Freight's going to be there. Ryan McKenna, a lot of different folks here. I always enjoy these events because we get to reconnect and connect with a lot of different people. I was just at another conference a couple of weeks ago in Salt Lake City, Utah. Had an amazing time there, and I was actually on a panel, kind of like a Shark Tank panel, if you will. Was able to hear 18 or 16 different pitches and choose some finalists and award about $600,000 in investment dollars to a couple of groups that won that particular offering there. But anyway, look forward to seeing you here in Charlotte in a little bit. If you have questions about that, feel free to reach out to us. Otherwise, don't forget about our next week's topic. Next week's topic doesn't look like it's been updated just yet. Let me just double check one more thing here. Nope, hasn't been updated just yet, but make sure you go back to the multifamilyinvestornation.com to check in to see what the next topic is for next week. And thank you for sticking with me and bearing through all the issues that we had coming up, and do that as well. Somebody was asking where I bought the Remarkable device. I believe you just go to remarkable.com. I think that's maybe where I bought it. Who knows? Yep, as it is, remarkable.com. Actually, we bought all of our team members one of these things about a year and a half ago for Christmas one year, and they just love it. So it's been a great thing to be able to take notes. It removes a lot of distractions as well. You don't have to worry about emails popping up or alerts or anything like that you might have on iPads. It makes it so that you can be very clean and very organized. And of course, you get to do little unique, cool things like I did with sharing it on the screen and stuff too. So thank you again for joining us. Look forward to seeing you back here next week, and look forward to meeting you and shaking your hand in Charlotte, North Carolina later on in the next couple of months. Talk to you later. Bye-bye.